Okay, folks, coming to you today from a secret location deep in the North Woods on the New Hampshire-Maine border. That is not a backdrop that you're looking at. Those are real trees, a real forest in the distance. It's part of the forest that borders our land at our cabin in New Hampshire. We are now going to move into notes, or Note 7, which covers corporate formation and financing. And at this point, we're getting into the part of the course that deals with business corporations, how they're set up, how they're charted, how they run, what their liabilities, responsibilities, duties are, what their powers are. So for the next three chapters, 7, 8, and 9, we'll pretty much be talking about corporate structure and how corporations, from ones as large as Google and Microsoft and Ford Motors and General Motors, down to your local business corporations, are set up and how they're managed. Okay, a corporation. Some definitions first. A corporation is a legal entity created and recognized by state law, occasionally by federal law, although the vast majority of corporations are created by the laws of the state. It may have one or more owners, who may be a natural person, a legal person, another corporation, a trust, and the corporation operates distinctly from and has a legal identity separate and apart from that of its owners. Under the 14th Amendment, going back to the late 1800s and reaffirmed again in Citizens United a decade ago, our Supreme Court has said that corporations, once they are created and they exist as they are basically legal individuals, they have certain rights and they have certain powers that the state and federal government cannot infringe upon, the same way that we as individual living, breathing citizens have rights and rights and privileges that cannot be arbitrarily withdrawn or removed or hampered by the state or federal governments. Now, normally, a corporation is managed and run by its officers and directors, and we'll spend some time talking about the duties and powers and liabilities and responsibilities of each of those. But they may not necessarily be the owners of the corporation. The owners of a corporation, a business corporation, are their shareholders. They hold what we call the equity, the beneficial value of the corporation, even though they do not have the legal right to make day-to-day decisions and to manage the day-to-day running of the corporation. But in exchange for giving up their rights to be in day-to-day control, what the shareholders obtain is something that is extremely valuable under our law, that you should understand by this point, is that they give up liability. They have what is called limited liability, so that the debts, the loans of the corporation, the torts that may have been created by the corporation or by corporate employees or agents cannot come back against the private assets of the shareholders. In effect, when you buy a share of stock, you're investing in a corporation. You're taking some of your money and you're putting it into this corporation, into this business, in the hope that you make more money, either by the share going up in value or by dividends that are paid, which are a share of the profits of the corporation. And you know, under our law, you cannot lose anything more if the entire company goes bust, if they end up creating some kind of damages that cost billions or trillions of dollars. The most that you can lose as a shareholder is whatever you put in from your investments to pay for that share of stock. So it allows individuals to become owners of corporations, to participate in the profits of business ventures without becoming personally liable, without putting any of their personal assets that they don't want in the mix. Any assets they want to hold aside are not at stake should something go hideously wrong with the corporation and its management, or with some product that damages someone, or some lawsuit that's brought against it. Now, corporate earnings. Because a corporation is considered a separate entity under our tax code at the moment, and under the tax code of most of the 50 states, and when I say our tax code, I mean the Internal Revenue Code of the federal government of the entire United States, but also under most state tax laws, corporations are taxed as individuals. So as we had talked about in the prior chapters, when we were trying to distinguish different types of corporate ownership and their benefits and detriments, one of the things about a straight business corporation is that every year, on whatever the close of its books are, whatever its accounting date is, it must make an accounting of whether it made any profits or losses. If it had losses, of course, it pays no taxes. But if it had profits, it now pays taxes on the net profits at that point in time. Now, these profits at that point, once the taxes are paid and all the bills are paid, they can be held, which means retained, or they're sometimes called retained earnings, for further business purposes, to invest in new equipment, to give employees raises, to buy a better health insurance plan, any number of things, to build a new building, whatever. Or they can be paid out to the shareholders in what's called a dividend. Now, when a corporation declares a dividend, and we'll talk about that when we get into shareholders, about how those are allocated and how they're spread out among the shareholders, but the dividend payments, when they come to these shareholders, they are taxed again, because the shareholders are also individuals under our tax law, and at that point the dividends are considered income by the federal taxation laws, and they are taxed again. All right. Some other definitions here. A holding company. A holding company is just a name for a company that owns a number of other companies. Berkshire Hathaway, of Warren Buffett fame, a very large corporation, very well-to-do corporation that's done very well for its shareholders over the last 50 or 60 years. In some respects, it is a holding company. It exists to buy and sell the shares of other corporations and to make money in those transactions. Tort liability. Liability means you are legally responsible. A tort is any type of negligence or intentional infliction of harm, negligent or intentional infliction of harm on another. And our law says that whoever inflicts that harm is liable, and if they are acting as an agent or an employee, then their employer, which here could be the corporation, would be vicariously liable for the damage done. And so tort liability is this idea that if you create injury, or if you send out agents or employees that create injury, you can be held responsible for those actions and for making whole the parties that were injured. Criminal acts. A crime is a wrong that is so considered so bad or so evil that the state itself takes up the prosecution of that act and will attempt to bring justice against the perpetrator. Corporations can be held criminally liable for the actions of their agents and of their employees. Now, you cannot send a corporation to prison, because even though it is an entity, it doesn't have physical reality, and the buildings and the assets of the corporation, they are not the corporation, nor are the employees or the directors or the shareholders of the corporation. So, but the corporation itself, as an entity, a separate legal entity, can be held criminally responsible for the actions of its agents and employees, directors or officers. And even though you can't imprison a corporation, you can fine the corporation as a penalty, and sometimes if the action is extremely heinous, the courts will abolish the corporation or dissolve the corporation as a penalty for criminal activity. Certainly, agents, employees, directors, and officers who commit criminal activity on behalf of the corporation, they are not exempt from responsibility, and they can be held individually responsible for their crimes, as well as the corporation being held responsible. Now, corporations are divided into a number of different categories. First, we would have a domestic corporation. Domestic corporation means it is chartered within this state, within this country. Foreign corporations are corporations chartered in another state or in another country. So a corporation that is chartered in New York, or a corporation that is chartered in England or Italy, to Rhode Island law would be they would both be equally foreign corporations. Right? An alien corporation, sometimes, at least on the federal level, would be a company chartered in another country. Public corporation. They are formed by federal or state government. There are filings that have to be made that are part of the public record. They are there to promote some public good or purpose. In our experience, the Providence Water Supply Board, the Narragansett Bay Commission, are public corporations. National Public Radio is a public corporation. They are set up by the government. They're not particularly the government itself, but they're kind of spun off as a separate entity to, again, promote some public good or some public purpose. Very often they are paid for, and their services are purchased by the government. A public corporation has to be distinguished from a publicly held corporation. So when somebody says public corporation, we are really thinking of like PBS, the public broadcast system, which has the radio networks and the television networks, Channel 2 that we see coming out of Boston very often. A publicly held corporation is a private entity. It doesn't have anything to do with government. The public part of it is that shares of stock are sold on the open markets, on the open stock exchanges to the public. The shares of stock can be purchased by anyone, which means that anybody who has the financial means to buy the stock can become a partial owner of the corporation. So you have to listen carefully and read carefully when you're dealing with corporations, because at first blush it kind of sounds the same. Oh, public corporation, publicly held. Two dramatically different things. Publicly held corporations usually do not have shareholders. They're treated as a charitable corporation. They may have members, or they may actually belong to some government agency. A closed corporation, and not closed with a D, but closed, C-L-O-S-E, is a corporation whose shares are not traded on the public markets. The shares are, by shareholder agreement, restricted to only be able to be transferred to existing shareholders, or sometimes families will take a family business, turn it into a corporation, and certain family members will be share owners, and they are only allowed to transfer or sell those stocks to other family members. Now, again, we had talked about already, and it will keep coming up, this idea of double taxation. Nobody likes to pay taxes once. People hate to pay taxes twice. So ever since corporate law and income tax law have banged together in the beginning of the 1900s, 1916 was when the Constitution was amended, so that for the first time the federal government could charge direct income taxes on individuals, including corporations. Since that time, there have been all kinds of efforts to find ways to allow parties to have the limited liability protection of a shareholder, but not have to pay the double taxation. We talked about that a little bit in the past dealings, in our past notes, when we dealt with subchapter S, with limited liability corporations. One of the reasons for setting up a limited liability corporation is to get that liability protection but not have to pay double taxation. Even with business corporations, under the federal tax law, there's a section called subchapter S, which allows certain types of closed corporations to be treated as what we call pass-through entities. And as we had said in the past chapters, a pass-through entity means that the entity is only taxed once. It is not taxed at the level of the corporation. It is only taxed when net profits are distributed out to shareholders, and at that point it's taxed as income to the individual shareholders. To be a subchapter S corporation, there are a number of requirements, and the IRS is very, very strict in enforcing these. First of all, the corporation must be domestic to this country. It cannot be an alien corporation or a foreign corporation originating in another country. Number two, it cannot be a member of a group of corporations. It has to be a freestanding entity, basically owned by live individual shareholders. It cannot be owned by other corporations. It cannot be part of a grouping of corporations that are all owned by one company or several companies. The shareholders, again, must be individuals or estates or trusts. They cannot be other corporate entities. There can be no more than 100 shareholders. So a large corporation at this point, like Google or Microsoft or General Motors, could not qualify to become a subchapter S corporation because they have hundreds of thousands of shareholders. There can only be one class of stock. And we're going to learn as we get into the next sections what classes of stock mean. But for our purposes here, there can only be one type of stock, and that would be stock, common stock. Every shareholder would have a vote in the corporation. Every shareholder would share in the profits of the corporation. And no shareholder can be a non-resident alien. So this type of ownership is limited to parties who are either citizens of the United States or people who have obtained their legal residency, or otherwise known in slang as green card status. They're the only folks in the IRS code that can be the shareholders of a subchapter S corporation. A subchapter S corporation is created by when you file your corporate paperwork. The Secretary of State's office and the states have nothing to do with it because it's a federal tax determination. You must, within a very short period of time, I believe it's 120 days, you must file paperwork with the IRS getting a tax ID number for the company and stating that you intend for this to be a subchapter S corporation. If you fail to meet that deadline, you will be considered what's called a Chapter C or Subchapter C, which is a regular business corporation subject to double taxation, at least for the first tax year that you are in existence. Corporations can change their tax status back and forth based on conditions. So there are times when even if you miss the filing to become a Subchapter S, you can at a later point in time file for that. If any of the requirements fail to be met by the subchapter corporation. So even though if you met all the requirements or you initially became a subchapter S, if any of the requirements change so that you no longer fit into this little box that's been created by the IRS, then you will cease to be a subchapter corporation. You'll be reclassified as a Chapter C business corporation, and double taxation will begin to apply. Now, there is such a thing in Rhode Island and a number of the other older states called a professional corporation. A professional corporation is created by a group of licensed professionals. So, matter of fact, my law firm that I practiced in for 30 years was a professional corporation. These existed in the days before limited liability companies existed, and they became a way to get out of the partnership where everybody is responsible for everybody else's torts and contracts and business dealings. By creating this corporation, you were taking the corporate liability and removing it from the individual members. But it was also treated from very get-go, from the first time these were created, as pass-through entities. So like a partnership, the members of this corporation or shareholders were only taxed when net profits came out to them as individuals. The corporation was not taxed as an entity. Only licensed members of the same profession can be owners, can be shareholders of a professional corporation. So for our corporation, Walsh, Brilley, and Nault, the only people who can hold those shares are the attorneys, who are the owners and shareholders. When one of us doesn't want to practice or wants to give up our interest in the corporation, or if we die, our shares have to be sold to the other attorneys in the corporation or to another outside attorney. Even our estate, our widows and children, have only a certain period of time during which they can hold on to the shares for the purpose of divesting themselves of them. Again, this was something that was created prior to the existence of limited liability corporations. I see that among the younger attorneys, they are more often opting just to become a limited liability corporation rather than being a professional corporation. For federal purposes, professional corporations could file and become subchapter S corporations, but again, they would still have to meet all of the requirements that a regular business professional subchapter S corporation would have to meet. So it was a little bit burdensome, a little bit onerous in the old days to set up a professional corporation. It is much easier today to set up a limited liability company because they can obtain pass-through status without having to meet all the requirements of being a subchapter S. Moving on to corporate formation. Corporations are chartered usually by states, although sometimes they can be chartered by the federal government, but most normally they are chartered by state. It becomes an important question, particularly if you're going to have a company operating over several states, to determine which which state you're going to file your corporation in, which state is going to be the home state. The laws have become more uniform over the years, but there still are significant differences from state to state. Many of the large corporations have their corporate home in Delaware, because going back to the early years of the last century, Delaware very early made it very easy to form a corporation, cheap to form a corporation. They gave corporations broad powers so that the corporations were free to do all kinds of activities without coming back to amend their charter or add things to their charter. And the tax structure in Delaware was very good at the beginning of the last century, and by meaning 1900s. Many of what we now know as national corporations today were originally chartered in Delaware. Now, even though a corporation has to pick a state where it will be chartered, it needs to file in order to do business in any state where it is actively operating. That gets to be a difficult thing, and I think we talk about it in later notes, but I'll go into it a little bit here. Certainly, if the corporation is going to own property, if it is going to have employees in another state, it will need to register as a foreign corporation in that state or a non-domestic corporation in that state in order to be correctly doing business. And one of the things you have to always keep in mind here, if you fail to keep your corporate charter properly in place, if you fail to file it, if you fail to register it in a state where you're now doing business, you may lose the benefit of the limited liability, or shareholders may lose the benefit of that, which becomes a very negative thing when all of a sudden somebody is getting sued or the company's getting sued, and now the lawyers for the plaintiff are claiming that the shareholders can all be dragged in because there is no limit of liability. So it's a very important thing, and I think I'm not sure if I had mentioned it before, but I know I have had students go on to work for CVS, to work for Amica, to work for other major corporations in Massachusetts and Rhode Island, and many of them work in the corporate offices doing nothing more than keeping track of the corporate filings among the multitude of states where these places operate, and making sure that all the paperwork is kept up to date, that the filings are in place, that there's no issue with the Secretary of State's office, that the corporate recognition as a limited liability corporation is maintained and is up and going at all times. You can pick a name, any name for your corporation. There are very few limits. However, you have to be very careful, and some states are more or less strict about picking a name that might be confused with another pre-existing corporation. For many years, Rhode Island was incredibly strict on this, and you would have to file your name in advance, and they would go through a process of checking through the records, and half the time your name would be rejected because it was similar or sound like or could be confused with the name of some other pre-existing corporation. Rhode Island has pretty much let go of trying to supervise that and have given up on that, so that today you can pretty much file any corporate name as long as it is not exactly the same as an existing corporation. However, just because you get past the Secretary of State's office doesn't mean that you are home free and clear. Many corporations, they file for trademark status for their name, and even under common law, even if they don't want to go through the federal process, and it is a federal process to get a trademark, even if they don't want to go through that process, under common law, the first person to use or the first entity to use a name in business has the right to that name. They own that name. So I have had situations where even though a name was not used in Rhode Island, if it was used in nearby Massachusetts or nearby Connecticut, one of my clients decides they want to try and use that name in Rhode Island. Within a few weeks or a few months of creating our corporation in Rhode Island with the same name, we get letters from the trademark attorneys for the corporations existing in other states saying that we cannot use their name. They own that name. It is a proprietary right, and that they will go to court to enforce an injunction against us to prohibit us from continuing to use that name. So it is a very real thing today. I would venture to say that if you tried to open a restaurant serving hamburgers and French fries that had any part of the name McDonald in it at this point, you would very quickly hear from the McDonald home corporate lawyers about how that name is sacrosanct and you cannot use it in your enterprise, even if your last name happens to truly be McDonald and you want to name your restaurant Joe McDonald's Restaurant in Rhode Island. I would venture to say that the McDonald's owns that name. It would have the right to stop you from attempting to use that name in a similar trade where it could become confused and where they have paid billions of dollars over the years to gain the advertising rights and to have the trademark rights to that name. A corporation is created in every state that I know of when you file a document called the Article of Incorporation. In Rhode Island and Massachusetts, you can draft your own, but there's no need to. The Secretary of State has a format online that you can either fill in online and file through the computer now, or you can download, fill it in on your own computer and mail it in, or submit it by faxing it or emailing it. It must include the name of your corporation, the number of authorized shares of stock that you intend to have for this corporation. All corporations must have an agent and an office. Now, the agent that we're talking about here is what we call an agent for service. Usually this would be an attorney, although it doesn't have to be. And what happens here is a corporation has no physical entity. A sheriff or a constable cannot walk up to the corporation and hand it a summons or a subpoena to show up in court or to tell the corporation that's being sued. So to get around this reality, every corporation must have a registered agent, and that agent acts as a person for receiving legal service of process for the corporation. As an attorney, I'm the agent for probably 20 or 30 corporations at this point in time, and what will happen is if they're about to be sued for anything, I will usually know about it before they do, and even their lawyers who may handle their day-to-day operations do, because as the agent for service, I will be served first by the sheriff. And then it is my duty as their agent, a duty of reporting and a duty of providing information. It is my duty to get the summons or the complaint or whatever it is to them in a timely manner to make sure that they are aware of it and they can legally defend themselves. It does not mean that I, as the agent for service, have to necessarily take on the defense. The corporation must have a business office. You must state, and it does not necessarily have to be in state, which is kind of interesting, but you have to have a primary office that's listed in the Articles of Incorporation. There is the name and address of an incorporator. Now, an incorporator is merely the person who files the paperwork on behalf of the corporation. And again, very often, this is an attorney or an accountant, somebody working for the people trying to set up the corporation, not necessarily the people going to own the corporation or run it themselves. Again, I've acted as incorporator for, I can't count the number of corporations during my career. This gets very interesting in this day and age where the press loves to poke around in legal things without paying to have lawyers on their staff, so that the general reporters and readers of the evening news don't know what they're talking about half the time. And I know a number of years ago there was an investigation going on in Rhode Island about pornography, and a company that was creating pornographic materials and possibly selling them illegally, and it got all over the nightly news and into the major newspapers that so-and-so attorney was the incorporator of this corporation. That doesn't mean that he or she had anything to do with the running of the corporation, or after the date when they filed the papers for the corporation, that they even had anything to do with the corporation at all from that point on. The articles of incorporation can include restrictions about transfer of shares, and in many closed corporations where people want to make sure that one of the original shareholders doesn't attempt to sell their shares to a third party, they can put right in the corporate documents on file with the Secretary of State that the shares are restricted in a certain way, but this does not have to be within those. You can also, if you desire, put in your articles of organization your articles of incorporation, what the organizational structure of the corporation is going to be. But again, you don't have to do that. I usually would advise against that because the organizational structures tend to change over time. As people get into business, they see how things run, see how things work. They don't always keep the structure that they set up at the beginning. In terms of limiting the shares and putting a statement in about limiting transfer of shares, that can be very important, particularly if you are somewhat nervous about the people you're going to the business with and you're afraid they might try to pull a fast one on a third party by trying to sell their shares or trying to use their shares as collateral for some loan that's not involved with the corporation. In those situations, it's not as critical a stopgap in later years to have that in your corporate paperwork. And the articles of incorporation can always be amended as to any of the things in it at any point in time. It means you have to file an amendment document, you have to pay a fee, but it can be done. So even if you make a mistake in the first filing, or you decide later on, a year or two into it, well, the way we filed isn't really working, we need to change our name, that is something that under the present laws can be freely done. The incorporator will file the paperwork, and then by use of paperwork will turn the corporation over to its shareholders, who will hold a meeting, and at that meeting they will adopt bylaws, they will elect officers and directors, they will get the corporation up and running, and as I said, the incorporator may never spend a minute of their life from that moment forward dealing with this corporation again. Their sole job is to get the papers filed at the Secretary of State's office and then to turn everything over to the shareholders who are going to be the owners of the corporation. There is a concept called a de jure, meaning in law, corporation, and the idea here is that corporate papers are funny things, and even now the Rhode Island Secretary of State reserves the right to reject your corporate papers for various things, and I have at different times filed papers thinking they're fine, assuming that everything was correct, and for some reason some clerk of the Secretary of State's office doesn't like something that we did, and they reject them. And today when we're filing online or we're filing by email, sometimes that's difficult to know exactly when that happens. You would have to keep going back and checking your email, checking the filing computer at the Secretary of State's office. And so there are times when you try to set up a corporation, the paperwork doesn't get filed correctly, or there's some deficit in it that would mean that technically you're not really a corporation, even if the clerk at the Secretary of State's office missed it and stamped your papers and put them in the computer. And in those situations, one of the things that parties can claim is that we did everything we thought we had to do, that we were operating as a corporation, we dealt with everything as a corporation, therefore, even though there was some technical glitch here, we are de jure a corporation, there is still limited liability, our shareholders are still protected. So this idea, as you can, if you think about it, usually comes into play after the fact, when a corporate entity is being sued and some bright young lawyer looks at all the paperwork and says, it wasn't filed correctly, there's really no corporation, and now 1 or 2 or 3 years into it, everybody, the shareholders, are seeing they're aghast that they might be sued individually for what they thought would be a safe investment behind a corporate shell. So in that case, they can always fall back on the defense of, we had a de jure corporation, Your Honor. We took all the steps that we needed to take. We operated the business as if it was a corporation, and we really had no idea that there was some technical defect in our filings, in our corporate paperwork. The Secretary of State never sent us a notice saying that they had not accepted our filing. All right. Over the years, there were tremendous arguments about corporate powers. What is a corporation authorized to do? And that is because the law very early applied to corporations something called theory of ultra vires. Ultra vires is Latin. It means beyond the boundaries or beyond the limits, or another way to look at it might be outside the scope of the corporate authority. Corporations traditionally, going back to the 1800s, early 1800s, had to be chartered by the passage of a special piece of legislation brought through the state general assembly and signed by the governor. And the state legislatures were very, very suspicious of giving people broad powers, of handing over their powers, so they very often would limit the authorization of the corporation to run. Many of the smaller railroad companies were chartered as individual corporations by the legislatures of the various states. And if you go back and read those old charters, they literally said that a group of shareholders can come together and we allow them to create a corporation, hereby create a corporation for the purpose of constructing and maintaining a railroad that will travel between this city and that city for the purpose of carrying passengers and freight and providing transportation to the general public. Under the theory of ultra vires in those days, that corporation could not invest in a boat. Let's say the railroad ended at the docks and they decided it might be a nice idea to buy, our railroad tracks end at the pier in Providence. It might not be a nice idea to have a freight line that goes to Fall River and goes to New London and even goes to New York City to take our railroad freight and move it along, and we keep making money from it. In the original concept of how corporations are supposed to operate, that would be illegal. They would have to do one of two things: either go to the legislature and create a new corporation that would be able to run the shipping business by boat, or they would have to go back to the legislature and seek a bill that would amend the railroad's original charter to allow them to be shipping over the waterways as well as over land railroads. So for many years, probably close to 100 years, the courts and the legislatures kept very strict supervision over this, and very often, again, shareholders could lose their protection by a plaintiff who had been injured, claiming that, oh, you weren't supervising, you let the directors, you let this corporation operate ultra vires, and anything that it did beyond its charter, it was being done as a partnership or some other form of business. You shareholders are therefore liable. Today, the statutes have very much changed that, and you can literally incorporate a corporation today and in its charter put that it is established for all legal purposes that may be conducted by a corporation under the laws of the state of Rhode Island. So, and we tend to do that today because, again, very often corporations will start out, companies will start out, business will start out with one idea, one business plan, one business program, and then when they get into the thick of things a few years down the road, they find out that certain things work better for them. They begin to drop off their original ideas and pick up other things, and to keep them from having to go back and renew their charter every time they went into a new business plan or a new business venture, we would tend to advise them today, say that you are starting this corporation for all legal purposes, and therefore the sky is the limit. You can go out into the great world and have this company do whatever it is that you would wish it to do. All right, that is the end of Note 7. So we're finishing this video. There'll only be one video for Note 7, and we'll see you again in a little bit as we go into Note 8, still talking about corporations.